Yo, what's up, everybody? It is Wednesday, November 13th. So the market was a little mixed today. Dow was down. Dow was up, Nasdaq down, and I think S&P eked out a little gain. We had the CPI came in basically as forecast. Bonds initially rallied, then they dropped down. I got to be honest, I am surprised right now. I mean, just right now looking at the fiscal flows, which of course is the core of my analytical framework. It's what I base everything on. We haven't seen any sort of a slowdown at all in these flows. I have seen a slowdown or a drop in interest income transfers, but that is marginal. That is very small. It's like 10 billion. It's nothing. The leading spending flows are easily outpacing that. So I don't see any slowdown ahead for the economy right now. I mean, I am curious about a couple of things. I'm looking at copper prices. They're down. I'm looking at petroleum demand, particularly distillate. Down. Distillate is diesel fuel. It's used in trucking and commerce. That's down. So, I mean, there's a couple of little elements out here. I'm looking at the drop in gold and silver, which I use as a barometer for economic activity. You know, those metals are down. So those are some little elements right now that, I mean, I'm just curious about why they're acting that way. I don't see anything in the fiscal flows right now that would suggest to me, I mean, basically, we're about even with the spending from last year. We're up a teeny tiny bit. So economy growing at 2.4%. In the CPI today, the reason for, I mean, we're stuck around 2.6% inflation rate year over year, and that's basically due to housing. The increase in housing and shelter costs, that was higher than more than half of the components in the CPI. And I don't see that really coming down because we just have a housing shortage in this country. I mean, you cannot expect to have a sufficient housing stock when they're building 1.3 million homes annually. I mean, that's just not enough. I mean, with a 335 million population, I mean, if you go back in 1968, when we had like 180 million population, we were doing like 2.2 million homes annually. In 1972, we were doing that. More recently, in 2006, we were doing that. And now the population, record population, and 1.3, we never ever recovered from the financial crash of 2008. I mean, housing starts have never recovered from that. And 1.3 million housing starts is just not going to be enough to boost the housing stock of this country. And so we have a shortage of housing. So I don't see inflation coming down much more than where it is right now. I mean, the interest rate cuts are going to help. As I always say, that the cost of credit is reflected in the cost of all goods and services. But on that note, you know, the Fed is going to go very slow because it's not going to see the inflation rate come down to the 2% level. I think it's going to be stuck here because of housing. All right. So again, everything really gets tossed into next year because we got a new administration, we got new policies. So I'm not going to go on right now about this. You know, there's going to be plenty of time that we're going to be discussing this. I want to talk again about the comments made on the site the other day where somebody said, you know, MMT is primitive. Of course, the government does not set rates. The rates just float around by themselves. What do you think? It's some magical thing that sets rates. And, you know, the government has to pay interest on its money because if it doesn't, nobody's going to buy. So if you're in sales, you know that in sales, you can't tell people what to do, okay? Because they're not going to listen. Or you can't just, even if you bombard them with facts and benefits and sizzle, I mean, they're going to have to come to their own decision. And somebody good in sales knows that the way to kind of guide your prospect to buy is to pose questions to make them think about their position and come to the realization that they really need your product or service. I'm going to try the same tactic here with an explanation of, the things I talk about with respect to rate setting and issuance of treasuries. So I'm going to try to do this in a question and answer. I'll play both roles. And maybe you could take this, maybe you could use this, maybe you could improve upon it, or, I've done this once in the past. So here we go. So the government doesn't set interest rates. That's some magical fantasy. Rates just float by themselves. Okay. Does the Fed set interest rates? Question. Does the Fed set interest rates? Well, we all know that we sit around every month waiting, on pins and needles for these Fed meetings to announce what the interest rate is going to be. I mean, everybody does that. There's a big lead up to every Fed meeting with speculation about what they're going to do, and then they announce it and they say, now the interest rate is going to be, 4.5 to 4.75%. So, does the Fed set interest rates? Yes, we all sit around every month prior to these meetings and up until these meetings waiting for that announcement. Okay, Mike, but they're only setting short-term rates. Okay, I see. So let me ask you this question. We know that people, investors, institutions, they watch what the Fed does. You just agreed with me on that we all sit around every month waiting for the Fed meetings to see what they decide on interest rates. So people, institutions, investors, whatever, they follow what the Fed does. Yeah, okay, we get that. So let me ask you something. Does the Fed look at economic activity as part of its rationale for monetary policy, as part of its decision-making process? Yeah, of course it looks at economic activity. Does it look at inflation? Yeah, it looks at inflation. Does it look at deflation? Yeah, it looks at deflation. Does it look at the labor market? Yes, it looks at the labor market. Okay, so we agree on that the Fed looks at economic factors, whether that be inflation, deflation, labor market, other things, to determine its monetary policy. We agree on that. We also agreed, you just agreed with me, that everybody watches the Fed. Right. So if inflation is a factor, and we know that people understand that the Fed looks at inflation in setting monetary policy, doesn't that mean they will react based on what they think the Fed is going to do? So in essence, the Fed is kind of manipulating their reaction function. All right. If people, and whether the Fed does it like intentionally or not, people follow the Fed. You just agreed with me on that. Economic factors are part of the rationale or what they use to set monetary policy. If inflation is going up, then the reaction by investors, institutions, whatever, will be to price in a Fed adjustment to rates, right out somewhere on the curve, depending on, how long they think inflation will persist. It might also be based on what the Fed says about its view about inflation. So on that score, couldn't you say that the Fed is also setting rates at other points on the curve based upon how they view the economic outlook, right? If you say no, then you also have to say no that the Fed doesn't set rates, which you already agreed with. So I think it's pretty normal, if you agree with the first part, that we all sit around every month for these meetings and for the Fed's statement to be issued and for Powell to do his or whoever the Fed chair is to do their press conference. We all follow that. Okay, there's a big lead up there. They're talking about that months in advance. So we're all sitting there waiting for that at 2 p.m. Eastern time for that announcement. So yeah, everybody, the Fed, and then the Fed tells us it sets a certain rate. Everyone follows the Fed to listen to what it says about its forward outlook regarding economic conditions. And based on that, people set their expectations for rates, and that is reflected in the longer end yield of the bond market. So in effect, the Fed is still setting that rate based on its outlook and what everybody is expecting from the Fed. So that's number one. The next thing, the government has to pay interest, or nobody's going to buy those securities. Yesterday, all right, let's assume that the government stopped paying interest on treasuries, and let's assume that nobody bought them because of that. What would have, first of all, before we even get into that, let me just back up. How are treasuries purchased? Well, what do you mean, Mike? You know, people can buy treasuries, well, okay, but how? What currency is used to buy treasuries? Well, you buy treasuries with dollars. Okay, so you got to have dollars. If you're going to buy $100,000 worth of treasuries, you have to have $100,000, right? Yes, you exchange the $100,000, you get the treasuries. Okay, where does the $100,000 come from? Well, it comes from my bank account. It comes from my bank. Yeah, but where did it get into the system, into the economy? The government spent it into the economy. That's the only place it could come from. It doesn't come from the banks. Banks issue credit. All right, if you have a loan for $100,000, let's say the bank gives you a loan for $100,000. So now you're like, wow, I got $100,000 in my account. Now go down to the bank. What if you go down to the bank and you say, I want to withdraw that $100,000? Then the bank has to have that government money, that cash, to give to you. All it gave you was a credit for $100,000. Ultimately, the money has to come from the government. All right? So if it takes dollars to buy treasuries, which it does, you can't buy treasuries with yen. You would have to sell your yen and get dollars. You can't buy it with euros. You can't buy it with Chinese yuan. You can't buy it with Canadian dollars. You can't buy it with British. You can't buy it with anything else. You can't buy it with gold. All of that stuff you got to sell to get dollars to buy the treasury. So the dollars have to be in the system before any single treasury gets sold. Do you agree? I think you would have to agree to that. There's no other way that it could happen. So even if those bonds weren't sold, let's say the government said, we're not paying interest anymore. Okay? What would happen? Or on your premise, on that, no bonds would ever get sold. So, what would be the consequence of that? Well, it doesn't stop the government from spending, because you already agreed that the money, the dollars have to be there first before you could buy the treasuries. It has to go in that sequence. It can't go in any other sequence. So if the dollars go, so basically the sale of the treasuries, when the government does sell treasuries, what is it doing? It's removing some of those dollars. It's saying, here, you take the treasuries now, and I'll take your dollars that were already in the system. So essentially, the sale of treasuries, all it is a drain on the dollars in the system. We call it a reserve drain. Okay? The government doesn't have to sell treasuries. And again, you could only buy treasuries with dollars that have to be put there first before anyone could buy a treasury. That's the only way it could happen. Okay? You can't buy treasuries if there's no dollars in the system. Is that hard to understand? So, okay, what would happen then if the government spends without draining those reserves, without the sale of those treasuries? Well, Mike, it seems like the dollars would build up in the banking system to a gigantic level. Right. That's what would happen. And that poses two problems. The first problem is when all those dollars build up in the banking system and don't get drained out. That's like a swimming pool overflowing, okay? That's a problem for the banks, because the banks, when they're holding those dollar reserves, which are assets for the banks, they need capital. So if those reserves kept piling up and piling up and piling up, the banks would become insolvent. The entire banking system would become insolvent. You follow? Yeah, I get it. You got the banks, too many assets, not enough capital. They would run out of the ability to raise capital, and they would become insolvent. Yes. Why is that? I don't know, Mike. Why is that? Because that's a regulatory thing. That's banking regulations. You know, the overseers of the banking system, that's the Fed, and the controller of the currency, and the FDIC. They set the rules. So basically, one way to avoid that is just get rid of that rule, saying like banks don't need to hold capital against reserves. Simple rule change would change the game. But I said there's two problems. The other problem is if those reserves keep piling up in the banking system, yeah, Mike, I get it. What would happen is that interest rates would drop to zero because there would be so much reserves in the banking system that it wouldn't cost anything for banks to lend to each other. In fact, they might be offering somebody, they might want to pay somebody to get these reserves off their books. So the rate might even go negative. So the sale of treasuries, it helps to maintain a level of reserves in the system that keeps a positive rate. And here we go again, back to the first issue. Why do you need positive rates? Why do you need positive rates? We've already determined, and you've already agreed, that nothing would change even if nobody ever bought a treasury. The only thing that would change, okay, is that reserves would pile up in the banking system and you would have to change that rule. That's it. There's no mystery. There's no primitiveness. This is an explanation. That's how it works. And I'm sorry if you feel like, no, they have to sell because it's borrowing. If you're into all that stuff, I mean, I just want to tell you, you are flat out wrong and you don't understand. And you have some kind of a mental block that doesn't allow you to understand. So the second part of this was not so much questions that I asked. I tried. The first part of that was asking questions. Everybody knows we all sit around and wait for the Fed to set rates. And we all listen to the Fed about what its expectations are about the economy, whether that's inflation or labor market or deflation or just, general economic activity, GDP growth or whatever. We all sit around waiting to hear because we're gonna adjust our portfolios or we're gonna adjust our outlooks based on the way the Fed looks at things. So it's setting the rate. Okay, I mean it's setting the rate. So that's it. You just, and it doesn't matter if they never sell a single treasury again. If you want to deal with the reserve situation and the problems that might pose to the banking system in terms of solvency, you change the rule. That's all. It's not a big deal. You don't need it. Again, the sale of government securities, of treasuries, came about during, when we were on the gold standard prior to 1933, when FDR took us off the domestic gold standard. The government did that to kind of, bring in the gold for itself, because that was the basis of its money. So it exchanged these certificates. They might have even been called gold certificates. They were basically the early treasuries. And it got the gold. And it was able to spend. It needed a supply of gold. We're not on that anymore. That whole setup, this whole setup that we still do, which is kind of like completely not necessary anymore, is based on stuff almost 100 years ago. It's based on stuff like 91 years ago. Prior to 91 years ago. So, I mean, we're not in that system anymore. They don't need to do it. And paying money on these bonds, again, I'm just going to say, paying money to people, wealthy people, or financial institutions, is ludicrous. It's ridiculous. It's a form of welfare that serves no purpose at all. And it's just a waste of government resources, so to speak, if you call, financial things resources when it's come from the government, which it's not. I mean, resources are real things, but it's just dumb. Anyway, I hope that straightens it out. Please like and subscribe, and go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. See you tomorrow. Bye.